Welcome to the deep dive. We've got quite a stack of material in front of us today.
Yeah, it looks like we're covering a lot of ground.
Definitely. Everything from the latest inflation figures, central bank moves, trade policy drama, specific company stuff, even luxury real estate trends.
It's a real mix. But seeing how it all connects, that's the goal, right?
Yeah.
Finding that bigger picture.
Exactly. So our mission today,
Mhm.
cut through the noise, find the key insights in all this, and help you connect the dots on what's really happening out there in the economy and markets.
All right, let's dive in.
So where should we start? Maybe the big economic pulse check, inflation and interest rates. We got some new U.S. data, didn't we?
We did. The PCE index, personal consumption expenditures, that's the one the Fed really watches. It eased a bit in April.
Eased how much?
Well, the headline PCE year over year was up 2.1%. That's actually the slowest growth we've seen since way back in February 2021.
Okay, 2.1% annual, and the monthly numbers.
Pretty modest. Just 0.1% growth for both headline and core PCE in April itself. Core PCE, that's minus food and energy, was up 2.5% annually, just a little tick down from 2.6% in March. Pretty much what economists expected.
So the trend, at least for April, was continued disinflation. Things cooling
Well,
down.
for now, yeah. Now, if we look over at Europe, specifically Germany, it's kind of a similar story, but maybe with a slight twist.
Oh, how so?
Their harmonized inflation for May, the preliminary numbers anyway, came in at 2.1%. So very close to that ECB target of 2%, maybe just a fraction higher than analysts were predicting.
Okay, so close, but maybe not falling quite as sharply as hoped.
Could be. But importantly, their core inflation dipped a bit to 2.9%, and services inflation, that cooled more noticeably, fell to 3.4% from 3.9%.
And services inflation, that's something central banks watch really closely, isn't it? Domestic pressures and all that.
Exactly. It gives a clearer picture than, say, volatile energy prices.
Okay, so U.S. inflation easing, German inflation near target, services cooling there. How are the big central banks responding? Are they seeing the same picture?
Well, this is where things get interesting. They're definitely not on the same page.
Divergence.
Big time. The U.S. Federal Reserve, based on their recent meeting minutes, they're really sticking to that higher for longer message on interest rates.
That's still,
Yeah.
even with the April PCE data looking okay. What's making them so hesitant?
They're saying they need more clarity, clearer signals from the economy overall. But they also specifically mentioned, and this is important, the whole tariff situation, which we'll get into.
Right, the trade policy uncertainty.
Exactly. So looking at the futures markets, like the FedWatch tool, it suggests September is maybe the earliest we could realistically expect a rate cut in the U.S. Maybe. It really depends on the data.
Okay, Fed's on hold, watching and waiting. What about the European Central Bank, the ECB?
Totally different story over there. Market data shows traders are basically convinced the ECB will cut rates at their meeting next week, June 5th. Like over a 96% probability priced in.
Wow. Next week? So the U.S. is maybe September, Europe is probably June. That's quite a gap opening up.
It really is. And that German data, especially the easing in services inflation, probably just reinforces the ECB's view that, yeah, disinflation is on track and they can start easing policy.
So for you listening, what does this actually mean? The Fed staying higher for longer in the U.S. keeps borrowing costs up, right? For cars, homes, definitely credit cards.
Absolutely. And credit card debt, I mean, the average APR is over 20% now. That's just brutal. Experts are saying, look, don't just wait for the Fed. You can often do more about your own interest rates right now.
Okay, so what are those smart money moves people should be thinking about?
Number one, tackle that high-interest credit card debt aggressively. Think about balance transfers to 0% cards, maybe a personal loan to consolidate, even just paying a little extra each month, focusing on the highest rate card first. It makes a huge difference over time.
Get rid of the most expensive debt first. Makes sense. What else?
Second, take advantage of high-yield savings accounts now. You can get rates around 4.5% online. Compare that to like 0.42% average at big traditional banks.
That's a massive difference.
It really is. On 10 grand, that's like $400 extra a year just for moving your cash. And these high rates won't last forever, especially if the Fed does eventually cut. So lock it in.
Good point. Free money, almost. Number 3.
Focus on your credit score. Especially when rates are high, a better score gets you access to loans and, crucially, much lower interest rates when you do borrow.
And average scores have dipped a bit recently.
Yeah, data shows a slight dip, maybe due to rising delinquencies, student loan payments restarting, stuff like that. So having a good score is even more valuable now.
How much difference can it make?
A lot. One analysis suggested moving from a fair score to very good could save you like over $39,000 over the lifetime of your loans, especially on big things like mortgages. Just paying bills on time, keeping credit card balances low, basic stuff helps.
Okay, so we've got inflation sort of easing but maybe facing headwinds, and central banks going in different directions. Let's shift to that policy landscape you mentioned, because it sounds like tariffs are really complicating things again.
Oh, definitely. They're back in the headlines, particularly U.S.-China relations. President Trump recently came out saying China totally violated that preliminary trade deal from back in May 2019.
The one that paused most tariffs for 90 days.
That's the one. And the U.S. Trade Representative also said China was slow-rolling compliance. So the U.S. side is clearly not happy.
How's China responding to that?
They're pushing back strongly. Their embassy spokesperson talked about U.S. abuse of semiconductor export controls, calling restrictions on companies dealing with Huawei's AI chips discriminatory.
So this isn't just about general trade anymore. It's laser-focused on advanced tech, isn't it? Chips, AI.
Exactly. It's a tech trade war. The U.S. has been tightening the screws for years, cutting off Huawei from U.S. tech in 2019, restricting advanced AI chips from NVIDIA and others in 2022. And it seems to be intensifying, with reports that even chip software makers are being told to stop selling to China now.
Wow. How are the companies caught in the middle, like NVIDIA, handling this?
Well, NVIDIA hasn't been quiet about it. They've basically opposed the restrictions. They were even blocked from selling a specific chip, the H20, which they actually designed to comply with the 2022 rules, to China.
Seriously. They designed it to comply, and it still got banned.
Yep. And NVIDIA says that ban is going to cost them around $8 billion in sales this quarter alone. Plus, they're sitting on like $4.5 billion worth of those chips they can't sell now.
Ouch. That's a huge hit.
Massive. And their CEO, Jensen Huang, even publicly questioned the whole premise, saying the idea that China can't make its own advanced chips is clearly wrong. He argues the restrictions just incentivize China to build its own chip industry faster.
Interesting perspective from a key player. What about the legal challenges to the original Trump tariffs? Are those still ongoing?
They are. It's a bit legally messy. An international court ruled against some reciprocal tariffs, but then an appeals court put that ruling on hold temporarily, so it's still up in the air legally.
Okay, now connecting this tariff mess back to inflation, what's the risk there?
This is a major worry right now. Economists are warning these tariffs could actually start pushing U.S. inflation back up in the coming months. It could counteract the easing we saw in April.
So that April PCE number might have been the low point for the year.
Some economists think so. Jeffrey Roach at LPL Financial suggested exactly that. Ellen Zentner at Morgan Stanley Wealth Management said the question isn't if tariffs impact inflation, but how much.
Okay, so tariffs are a potential inflation driver. That definitely explains some of the Fed's caution.
Absolutely. And speaking of policy adding complexity, there's this other thing moving through Congress, the One Big Beautiful Bill Act. It passed the House, needs the Senate, and inside it there's something called Section 899.
Section 899. Sounds obscure. What is it?
It's being called potentially the biggest change to how the U.S. taxes foreign investment in decades. It basically targets investors from what it calls discriminatory foreign countries.
Meaning countries with taxes that hit U.S. companies hard, like those digital services taxes in Europe.
Exactly. Think France's 3% tax on online revenues that mostly affects U.S. tech giants. So Section 899 is the proposed U.S. response.
And what does it do?
It would slap an extra tax on the U.S. income earned by investors from those targeted countries. And it would increase each year by 5 percentage points annually, potentially hitting a total extra tax of 20%.
Wow. So using the U.S. tax system as leverage against foreign taxes, what are the potential side effects people are worried about?
Well, experts are raising red flags. George Saravelis at Deutsche Bank warned it could make holding U.S. dollar assets less attractive for foreign investors, maybe even trigger capital outflows.
Less demand for dollars in U.S. assets.
Potentially. And companies in those targeted countries that earn money in the U.S. could be hit. Think big hotel chains or service companies listed in London, for instance. Even foreign governments and central banks holding U.S. treasuries could be affected.
Like France and Germany. They hold a lot of U.S. debt, right?
They hold a combined $475 billion. And this tax could significantly lower their effective yield on those treasuries, maybe by a full percentage point, according to Deutsche Bank.
Which could make them think twice about buying U.S. debt. Maybe look at German bonds instead.
That's the concern. Beat Whitman at Porta Advisors suggested exactly that it could push investors towards German bonds as a safe haven. Some are calling it the weaponization of U.S. capital markets taxation, but it's worth noting legal experts expect big changes in the Senate, so this isn't final yet.
Okay, so between tariffs potentially boosting inflation and this Section 899 potentially disrupting capital flows, the global financial picture looks pretty choppy.
Yeah.
How's this actually playing out in specific markets like energy?
Yeah, we're seeing impacts. OPEC Plus is meeting this weekend. 8 key members are expected to announce they'll increase production starting in July by about 411,000 barrels per day.
More oil supply. What would that do to prices?
Well, some analysts think it could cause crude prices to drop maybe 10%, potentially hitting the lowest level since 2021.
Why would they increase production now with all this uncertainty?
It's tricky. Gauging global demand is tough with the trade war noise. Plus, there have been issues with some OPEC Plus members not sticking to their existing quotas, so maybe this is an attempt to rebalance things.
Could mean lower gas prices for us, potentially.
That's the hope, yes. Also in energy, Chevron is making cuts, over 200 jobs going in Texas in July. It's part of a bigger plan to cut their global workforce by maybe 15–20% by 2026, trying to simplify and get more efficient.
And they're also navigating that complex situation in Venezuela.
Right. They apparently ended some contracts there, but are keeping their staff and assets, sort of threading the needle with recent U.S. guidance on sanctions.
Okay, shifting to another heavy industry steel. That U.S. steel sale to Japan's Nippon Steel, that looked dead for a while. What's the latest?
It seems to be back on track. President Trump is expected to make an announcement. Sources are saying Nippon will likely close the deal at the original $55 per share price.
But didn't President Biden oppose it on national security grounds?
He did initially, but Trump ordered a new review, and it looks like they found a way forward.
How? What changed?
It seems the deal now includes the U.S. government holding what's called a golden share.
A golden share, like the government owns part of the company?
Not exactly equity. It's more like a contractual right, according to Senator McCormick. It would give the U.S. government veto power over certain things, influence on the board, guarantee an American CEO, and a majority U.S. board. Basically ways to maintain control over a critical sector, as the USTR put it.
But the Steelworkers Union isn't convinced.
No, they're still very concerned. Their president said they worry Nippon could hurt domestic steelmaking and union jobs, citing what they call Nippon's track record on trade laws.
Okay, so energy and steel navigating these choppy waters. What about the other side of the coin? Those areas seeing huge growth, like AI.
Yeah, that's a stark contrast. Look at Anthropic, the AI startup. They've apparently hit $3 billion in annualized revenue.
$3 billion already.
Yeah, driven largely by demand for their AI that helps write code. One venture capitalist described their growth in just one quarter as totally unprecedented compared to even fast-growing public software companies like Snowflake.
That's incredible speed. Shows where the money and excitement are flowing.
Absolutely. It really highlights that rapid tech adoption, even with other economic clouds around. Now, speaking of tech figures, Elon Musk. He seems to connect a few threads here. He's leaving his government role.
Yeah, his official stint leading that Department of Government Efficiency, DOGE, is ending. Though he says he'll stay on as an advisor, keep an office at the White House.
That DOGE initiative didn't quite hit its massive spending cut goals, did it?
Not even close, apparently. And reports say it's losing staff. Musk also clashed with aides and, interestingly, broke with the president on those tariffs and that Section 899 bill we talked about. And Tesla itself. The company's performance seems complicated.
Very. Car sales in China and Europe haven't looked great recently, but the stock, it rallied over 22% in May.
Why the disconnect?
Could be a few things. Maybe investors like Musk signaling more focus on his businesses now. There's also a lot of buzz about their robo-taxi service launch, maybe happening June 12th in Austin. And Tesla is maybe seen as better positioned on tariffs than some U.S. rivals because of its manufacturing footprint.
So struggles in the core business, but hype around future tech and maybe some strategic advantages boosting the stock. A mixed bag. Anything else jump out in specific sectors?
Yeah, a tough break in biotech for Regeneron. Their stock took a nosedive after a late-stage trial for a COPD drug failed. Analysts were apparently quite surprised. They expected it to succeed. It just shows the risk in drug development.
Definitely. And you also looked at luxury real estate, specifically the Hamptons rental market, as sort of a high-end sentiment indicator.
Right, and the signals there are interesting. Summer rentals are reportedly way down this year, like 30% overall. But for the really expensive, ultra-high-end places, brokers are saying rentals are down 50%, maybe even 75%.
Wow. Why are the wealthy renters holding back? Just waiting for last-minute deals?
That's part of it, brokers say. People waiting for prices to drop. But privately, brokers are also pointing to stock market jitters, general economic uncertainty, and yeah, the tariff situation keeps coming up.
So that dark noise, financially and geopolitically, is making even affluent people pause big discretionary spending, like a Hampton summer rental.
It seems like it. One broker said huge waterfront places that are normally rented by April are still sitting empty now in June. You're seeing price cuts, more flexibility on stay lengths. It suggests deferred decisions, maybe caution setting in, even at the top end.
That's a fascinating little data point, suggesting broader uncertainty might be seeping in.
Exactly. It's anecdotal, sure, but it adds another layer to the picture.
Okay, let's zoom out just a bit from the immediate market noise. There's this slower moving trend you flagged, the declining U.S. birth rate.
Yeah, this is a big demographic shift, and the concern among experts is that policy responses just aren't keeping up with how fast the birth rate is falling.
And the main worry is the long-term impact on the economy. Workforce size, funding social programs.
That's the core concern. Fewer workers supporting a growing number of retirees could really strain things like Medicare and Social Security down the line.
Have there been policy ideas to try and reverse this, like payments for babies or bigger tax credits?
Yeah, those ideas are out there. Lump sum payments, bigger child tax credits, even these proposed Trump accounts with seed money. The House passed a bill with some of this, but experts are pretty skeptical these financial incentives alone will make a huge difference. They point to a deeper cultural shift. More young adults are prioritizing, education, getting financially stable, building careers before thinking about kids, or maybe choosing not to have them at all. It seems more complex than just throwing money at it.
And just to loop back briefly to Elon Musk, that DOGE department he ran reportedly made staff cuts at the Social Security Administration.
That's what MarketWatch reported.
And so-
It's kind of ironic, right? An efficiency drive cutting staff at an agency that's facing huge long-term challenges precisely because of these demographic shifts from the falling birth rate shows how things connect in unexpected ways.
So stepping back from all these pieces,
Mm.
wow, we've got a global economy where inflation is easing, maybe, but tariffs could push it back up. Central banks are splitting paths. New tax policies could shake up investment flows. Some sectors like AI are booming while others face headwinds or setbacks. Luxury consumers are maybe getting cautious. And underneath it all, these long-term demographic pressures are building, plus warnings of financial fragility.
It's definitely a complex mix. You hear people like Jamie Dimon at JPMorgan Chase, even while their bank makes record profits, warning about being prepared for unexpected risks. He talks about history, how firms doing great one decade can disappear the next. He finished by saying it's a rough world out there.
It really feels like a time of deeply conflicting signals, doesn't it?
It does. But looking across all these different sources, the econ data, the policy news, the company specifics, the market anecdotes, that's how you start to get a richer, more complete sense of the forces interacting. You see how tariffs connect to inflation, connect to Fed policy, connect to maybe even Hampton's rentals.
It helps make sense of the noise.
Exactly. It gives you a better framework for understanding what's going on around you.
So here's a final thought to leave you with. Considering all these contrasting signals we've discussed, easing inflation shadowed by tariff risks, explosive AI growth next to industry struggles, record bank profits alongside warnings of fragility, robo-taxi optimism versus weak car sales, even caution from the super rich. What does this period tell us about risk and opportunity right now? Is the game finding those pockets of hypergrowth like AI, or is it more about successfully navigating this increasingly complex web of policy and geopolitical risk? Something to mull over.